Welcome back, everybody, to another episode of Smart Money, Smarter Moves with our CIO at Freedom Family Office, Kyle Cain, and me, your host, Samir, Director of Client Engagement here at Freedom Family Office. This week, I want to talk with Kyle about some of the market updates we saw. There wasn't anything huge or significant and many headlines like we discussed a couple weeks ago. But I think when we look at this week, Kyle, there were some things around the inflation data numbers we saw. President Trump is starting to interview Fed candidates. We saw some updates on Intel. When I last spoke to you, I saw Trump had put something on Truth Social about Intel CEO. He should resign. He's got ties to China. Then they had a meeting. And now all of a sudden, I just saw yesterday the US is considering investing in Intel. And even more information came out that they might use the chip deal that they made with like NVIDIA and the sales they make from there to invest in Intel. Maybe we can just start there, Kyle. What are your thoughts on the whole Intel situation?
So yeah, I mean, obviously, a week can change a lot for a company. Intel sold off quite a bit after Trump made the comments about, the CEO should fire. And like I said, I don't believe a president should necessarily be, they should care obviously what's happening in corporations. They should be meeting with CEOs, but should they publicly be saying a CEO should be fired? I don't know. I think that should be more left to the board of directors and the investors to vote on. But obviously the meeting must have went well because there's been an about face here and said the meetings were good. And now, Trump's talked about actually investing in Intel. I would say two things, right? Like, in my opinion, I believe in free, capital markets, and a government shouldn't be investing in, in public companies and things like that. However, right, we do want to win the chip race, and we are relying on Taiwan Semiconductors as the biggest, player in that field. So to get their foundry business up and running, they've already received $8 billion from the CHIPS Act. Previously, I think that's a better way to go. But if that holds a little bit more accountability, like you're saying, it's the same thing. You're granting money to a company, but now if you're owning a piece of it as a little bit of a higher accountability and focus. I mean, I guess it just means that the government's committed to make that company work. So it's a boost of confidence. That's why we're seeing it rally, quite a bit, 15% or so, here in just a couple of days. So, I guess to be determined on how it actually works out, whether legally a government can do that. Either way, it sounds like there's some support to try to, and then the same thing where he's mentioned the semiconductor tariffs. He just came out with a little bit more language that he's planning on doing something similar like he did with the pharmaceutical, that he's might be doing with the pharmaceuticals, whereas you start off with a low number, right? Give exemptions to companies that are investing, like Taiwan Semiconductor. They're committing capital so they can, avoid some tariffs, but then the tariffs ramp up over years. So it just has more incentive to build more in the U.S. So to be determined, but it's interesting to say the least. How things can change just in a couple weeks. Coming out of the White House.
Oh, absolutely. And then what about the numbers came out this week? I saw markets hit again all-time highs. And so it's impressive to see. I saw the number, Kyle, since that April drop with what they called Liberation Day, markets rallied over 29% since then. Even before we get into the numbers, are you surprised at all? As a CIO, I'm sure you've seen cycles on many different, quarters and years, but does this surprise you?
Oh, it definitely, caught me a little bit by surprise with how fast this rally is. I mean, it was the fastest rally from a 15% plus pullback in the markets to recoup, the all time highs ever in history. So it was fast and furious, right? Even though throughout the entire run up, that's why they call it the stock market can sometimes climb the wall of worry because there was no real clear data on how this was going to play out. There's still tons of uncertainty, but yet the markets continue to make newer highs. So I'm certainly surprised by it, but the markets do that. They're very forward looking and they're trying to look at where's the end case, and they were hoping for the best. We said sort of on our last podcast how much the retail investor has been involved, and they've been just kind of accustomed to buying the dip anytime there's a little bit of a sell off. Money's getting put back into the markets. So yeah, it's surprising. Earnings have kept up though, right? And Q2 earnings season has been great. So let's say it's justified, right? There's still some risks that are out there, but It's justified. It happened pretty quickly, all from, again, margin expansion, not really that much of earnings growth. Even though, again, we are seeing earnings growth.
Right, right. No, it's reassuring to hear because I've heard people in different rooms say, I missed the rally. This is shocking. I never thought it's coming. And, some people are like, well, I did see it coming, but even from your perspective, you manage all these portfolios and you were shocked. So it's reassuring to hear for listeners. How about this
And
inflation?
then I'll address that. Like, is it too late? And the answer is no. Right? Like I said, there are plenty of risk out there that Um, I would still say majority of economists have a higher than normal recession percentage. Usually it's like, everyone says there's like a 15% always recession risk. And during the April sell off in May, all economists increased their recession indicators to like 70% chance. Now they're down 30 to 40% at most of the main economists out there. So it's still elevated. Um, but, we kind of look at where we're at in an environment where we can talk about here inflation and interest rates, the Fed should be cutting. We're going to get a fiscal boost from the tax bill. Um, you know, we we're seeing still the beginning, in my opinion, the AI capex cycle, which I've just read some reports saying that in 2024, it's expected to have increase GDP by about half a percentage point, and it'll probably at least do that, if not more, even though we're seeing the CapEx ramp up for the next couple of years. So the point is, yes, if there's any pullback, I'd be using it as a buying opportunity because I think it still has, we're not out of the woods yet, but there's legs, and it's not too late to invest.
Are there things when you look at bullish and bearish, are there scenarios or things that you suspect could be the catalyst for the contrary, for like a 10% correction or pullback?
Well, like you said, I mean, I think majority of investors are expecting that we're going to see, some let's say less than perfect economic data, over the next couple of months. And I think they're going to look through it. But, eh, you know, you say that, and it's been reading up to it, and the economic data has been pretty good so far. We'll see how the market actually react when those reports come in, right? Like so, this week we got CPI data. The regular CPI data came earlier in the week, was pretty much in line with what the markets expected. Core CPI was about 3.1% versus 3% expected. But when you looked under the hood, it wasn't too much goods inflation, which is what you would expect from tariffs, right? It was more services inflation, which indicates that consumers are still spending, which is a good thing. So the markets took it, went to all time highs. Then the producer price index came out later in the week. And that one then showed it had a significant bump up, right? It was a core PPI was expected to come in at like 2.9%, and it came in at 3.7. So that, 0.9% jump in the 1 month was kind of the fastest in 3 years. And initially it shook the markets a little bit and the market started to sell off, thinking that the tariffs are going to have a big impact. And, that's going to obviously, if prices are rising, consumers can only have only so much dollars to spend. And we could see a market sell off. Well,
Yep.
two things. If you looked under the hood, you know, the point is we know that inflation is gonna go up, tariffs, right? The taxes have to be paid by someone. So far, we've seen businesses eating a lot of it. But that's not gonna happen. I think that's more due to uncertainty, and they're gonna start raising it. I think at the end of the day, though, right? So any of these things on job numbers came out not that great. We had initial sell off, right? So I think over the next couple of months, there could be some of that data that comes out that shakes the market, and we get a little bit of sell off. If so, again, my advice would be I'd be a buyer in that environment, right? As far as why, right? I think it's like, what's the Fed going to do? Right now, the markets are pricing in pretty much a 90% chance that they cut rates in September. Um, it went from it was 100% after the CPI data came out, went to 90% after PPI data came out. Markets are pricing in about 2 rate cuts this year, maybe a little bit percentage for a third rate cut. And obviously, there's concerns that with the PPI data coming out that with inflation, the Fed can't cut. Well, I guess here's the way I word it: is there is going to be inflation. Prices are going up. But at the end of the day, for prices to stay elevated and for inflation, money supply has to be increasing as well. Meaning right now, if the consumer only has so much money to spend, right? If prices and goods are going up and they're gonna either cut back on it or they have, now they're spending the same, there's less money for it, to be spent somewhere else. So as those prices are going up, other prices are going down. So the overall inflation shouldn't be as big of a concern. The, Fed governors should look more at what's the overall money supply, and that's been growing, but not, significantly nearly as much as it was
Right.
after the pandemic. So ultimately, right, inflation is coming down. The Fed should be able to cut. Um, that can help so many of the, we know the big tech companies, AI, they're all doing well. It's been sort of the small caps, the lower end consumer, those are the ones that have been struggling with inflation and high interest rates. So hopefully the housing market can start to, heat back up. Small businesses can start to do better if we can get lower rates over the next, beginning in the third quarter and into next year.
Yeah, the Fed watch tool from CME is indicating that there's a 93% chance of a rate cut next month. So you think we're pretty much, everyone should expect a rate cut next month. Yes.
Yeah. Yeah. I would say that's, you know, quite a few other Fed governors have came out, still less than half, but at least 4 or 5 of them came out suggesting that they would be open to a rate cut in September. So I think it's more than likely. Scott Bessent, he said he made some comments about they should do a 50 basis point, and then he said it should actually be 150 basis point, cuts. Uh, he kind of walked it back and saying he's not trying to tell the Fed what to do, but I don't think that's going to happen. I think there's no chance of that happening, but I would say it should be baked in my opinion, a 25 basis point cut um, in September, and then it's just a matter of do they do it back to back or do they pause after the first rate cut? I'm kind of leaning towards still maybe a back to back cut right now is my expectation.
Right. Yeah, no, that's helpful to see. And was the retail sales data of any concern at all? I mean, I saw that for July. It looks like from what I heard and you say, and then the general economy, it seems like a healthy picture for the U.S. consumer, so the audience.
Yeah, so I mean, it did in the first half of the year. Consumption slowed from the previous years, but the data's been a little mixed because there was some front running before tariffs of individuals buying automobiles, and then there was a big sell off after the tariffs, started to hit, where consumers didn't rush out because they've already bought their automobiles, so retail sales slumped a little bit, and then the data came out saying that there was continued growth, about 0.5%, from the previous month. I would say it's basically still suggesting that there's strong growth, right? There's the consumers holding up. It's not, they only have so much purchasing power with the rising prices over the past few years, but consideration all else, they're still spending. So there's no concerns right now that there's a big crack. It's just like I said, a little bit of a slowdown, but still growth. Um, yeah.
Yeah. And last question while I have you here. This episode will be coming out next week. It's Friday, August 15th, but from now to then, I believe Trump is getting ready to meet with Vladimir Putin. I saw Trump just landed in Alaska. That meeting is coming up. Does that geopolitical event, anything that investors or people that might not even be invested or entrepreneur listeners should know about? What are you looking for from that meeting that he has with Putin and in specific relation to the markets?
So I would say twofold. For the average investor and most who are following some sort of asset allocation strategy, right? Geopolitical events don't usually have a significant impact on the stock market. From the more micro level, yeah, there could be some implications. Like obviously, the whole world wants there to be some sort of peace deal that works out, and we stop the fighting in Ukraine and Russia, right? That can significantly help just overall, right, humanity, but it can help Europe. It can help. We could have deals, whether we should or not, with Russia could help, lower oil prices even more. They're already low prices than they are. So again, I would say from a micro level, right, it could help Europe. It might hurt actually defense companies a little bit in the short term. I think there's enough long-term tailwind of money being spent. Like we're spending more money on defense. Germany's spending more defense. So I think there's still more money that's a good place safe place to, have some money invested in defense companies. But if there is a peace treaty, we could see a quick drop. So, ultimately, like I said, there's certain areas that'll benefit more than others or get hurt more than others. But in the long run, it shouldn't have too much of an impact on someone's portfolio or what they should do. It's not like it can be a huge risk on moment or risk off moment. It just would be right like there's some minor changes you can make, and it would just be a good thing for the world.
That's a smart money, smarter move type gem to understand the impact of geopolitical events on your portfolio. Sometimes the fears are abrogasted and just seem more exaggerated than they are. So, thanks for that, Kyle. That is this week's episode of Smart Money, Smarter Moves. If you guys are interested and like the insights from Kyle, we can take this a step deeper, and Kyle will do a free portfolio review. So, if you are listening and you have at least $1 million of your portfolio, Kyle will take a look at that portfolio and see if you are fully optimized and see what Freedom Family Office could do. So go to freedomfamilyoffice.com or feel free to email Kyle and myself, Kyle at freedomfamilyoffice.com and Samir at freedomfamilyoffice.com. And we can definitely set some time up. Any parting words from you, Kyle?
No, I appreciate the time.